The head and shoulders is universally recognized as the premier rejection structure in technical analysis, but most traders execute it based on flawed retail assumptions. The professional blind spot is looking for a specific geometric shape instead of reading the underlying order flow that creates it. A valid head and shoulders represents a mechanical visualization of price imbalance. This structure takes form because buyers or sellers are actively aggregating liquidity to force a structural shift in the market. Treating the market like a simple pattern matching exercise leads to blind execution and forces traders into institutional traps. We are going to dismantle the structure from first principles and build it back up mechanically. You will see exactly how institutional players grab liquidity during the pattern's formation to fuel the move. We will also decode how volume signals mechanical exhaustion before the pattern even triggers. This breakdown leads to a precise execution logic for entering the market once an established channel finally breaks. Understanding the mechanical need for the market to physically build this pattern is the only way to separate a premier trend reversal from market chop. The process begins when an established trend hits a clear line of resistance. The left shoulder establishes an initial pocket of liquidity. The right side of the pattern later attempts to grab this concentrated pocket of orders to fuel a breakout. A stop run forms the head, serving as the primary catalyst for the pattern's potency. The best setups feature a head that aggressively violates the resistance level, triggering the pooled stop orders on a massive volume spike. Deeper penetration into resistance results in a more potent pattern because it captures a larger amount of trapped liquidity. Following a successful stop run, the price action undergoes a violent rejection. A large engulfing candle crashes back below resistance, creating a new supply zone. Shallow heads offer less protection for the trade, requiring a reduction in share size on entry. The head harvests liquidity and constructs a protective supply zone to defend the formation of the right shoulder. Following the rejection from the head, the focus shifts to the neckline. The neckline serves as a line of equilibrium where the structural imbalance is temporarily balanced. Physically, the market requires a right shoulder because it cannot break the neckline immediately. The dominant side lacks enough active participants to drive price through support on their first attempt. The right shoulder retracement acts as a deliberate flagging maneuver. This move drains out opposing orders and aggregates the concentrated pressure needed for a retest. Volume analysis predicts the success of this flagging maneuver. Read the volume gradient as the right shoulder wedges upward toward its peak. Price action wedging higher while volume steadily decreases provides a visual signal of exhaustion. The right shoulder provides the kinetic energy required to shatter the equilibrium at the neckline. Demanding textbook symmetrical patterns is a common misconception in professional analyses. Messy or lopsided shoulders are valid as long as volume exhaustion is present during the formation of the right shoulder. Lopsided shoulders indicate a weaker internal structure, making it necessary to cross-reference price action in major market coxes like the QQQ or NVDA to confirm the move. Trading this structure requires rigid, scaled entry mechanics. The initial stop is set at the peak of the head. A breach of this level breaks the pattern. Entry 1 is a half-size starter position at the head when it hits major resistance. Entry 2 adds at the extreme pivot of the left shoulder as price returns from the head. Entry 3 occurs on the break of the angled trend line that contours the right shoulder. Entry 4 triggers at the break of the neckline, followed by Entry 5 during the retracement test of that same level. Layering these 5 specific entries based on structural milestones creates a dynamic, risk-managed campaign. The microstructure of the pattern interacts dynamically with macro trading channels. A primary risk assessment requires price action to decisively break through the established macro buying or selling channel. The formation of the right shoulder often acts as the physical test against the broader channel trendline. If the neckline is never broken, the pattern is officially void. A failed break morphs the structure into a same-direction wedge, seeking follow-through in the original direction. Protect trades at the neckline to verify the viability of the channel break. Calculate a 1-to-1 risk-reward ratio from the head to the neckline to set a limit order exit. Alternatively, half the shares can be held until they test the extreme support or resistance formed by the left shoulder. Trading the true mechanical exhaustion of liquidity provides a massive, reliable edge over simply tracking basic geometric shapes. Waiting for the stop run, verifying volume exhaustion, and demanding a macro channel break provides a map of institutional surrender.